Hi and salam to everyone. My name is Tiffany Edmund from University Kuala Lumpur, and this is our video for investment analysis with the topic of common stock and stock valuation. This is our lecturer for this subject, Sir Muhammad Arif bin Abdul Rahman, and this is our group member, which is Tiffy, Matt, Dini, Gina, and Sarah. First, let us pray.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله رب العالمين الرحمن الرحيم مالك يوم الدين إياك نعبد وإياك نستعين اهدنا الصراط المستقيم صراط الذين أنعمت عليهم غير المغضوب عليهم ولا
Okay. What is common stock? Common stock is a securities represent ownership in a corporation. It has no maturity. Holders of common stock, or we call it shareholders, exercise control by electing a board of directors and voting on corporate policy. And common stockholders are on the bottom of the priority ladder for ownership structure. There are two characteristics of common stock, which is the residual claim, also known as liquidation event, and limited liability. Okay, the first one is residual claim. Is when the firm falls into bankruptcy, common stockholder will receive asset, but only after all creditors, bondholders, and preferred stockholders receive them first. Okay, for example, we should first pay all interest from our earning before interest tax, which is the interest from the creditors and bondholders, and next is tax, followed by the preference share dividend. Then we will get the earning available common stock of common stockholder. Then the ESC will be divided by the number of shareholders to get the amount of earning per share. Okay. The second one is the limited liability. When the firm goes into bankruptcy, shareholders only lost their original investment only and not their personal belongings. And this is the voting rights. Owners have the right to vote whether to allow stock split, stock right, and stock dividend. Okay, stock split is a way to create more stock but at a reduced par value, and stock right is the right given to the existing shareholder. For example, this is the existing shareholder when issuing new share before announced to the public. And the third one is stock dividend, which is to give dividend by cash, stock, and property. Next is the preemptive rights. A right is an option that gives the existing shareholders an opportunity to acquire additional new share at a specified subscription price or exercise price. And this right is to maintain shareholders' proportionate of ownership in the company. Preemptive right is to keep the percentage of ownership the same and maintain voting control, share of earning, and share of asset. Okay. The next is other right of common stakeholders. which is to inspect the books and records of the company and cancel management for any unauthorized activities. Okay. Common stock dividend. The board of directors determines whether or not to pay dividends to the shareholders, and the dividend payment is depend on the performance of the company. The weak company will suspend the dividends until its balance sheet improves. And there are four important debts for the investor, which is the first one is debt of declaration, where the board of directors announced that dividend will be paid to the shareholders, and the second one is the record debt or lodgement debt, which is the last debt for those entitled to the dividend are registered. And the third is payable debt, where the check are mailed to the shareholder by company's trustee bank, and ex-dividend debt is it occurs 10 working days after the lodgement debt. Okay, this is the few types of common stock, alternative investment, and investment style. And types of common stock, for example, the blue chip, income statement, growth stock, tech stock, speculative stock, cyclical stock, defensive stock, mid-cap stocks, and small-cap stock. For alternative investment is buy and hold, high income, quality long-term growth, aggressive stock management, speculation, and short-term trading. And for the investment style, it include the growth investing, value investing, sector rotation style such as the interest-sensitive stock, consumer durables, capital good manufacturer, defensive stock. And the last one is the momentum investing. Okay, that's all from me. Thank you.
So, I will proceed to the next topic, which is stock valuation model. What is stock valuation model? In a simple words, it can be defined as the value of any asset is the value of the present value of all future cash flow it is expected to provide over the economic life. Stock valuation model have its own purpose, which is to obtain a standard performance that can be used to judge the investment merits of a share. It is called as stock intrinsic value. Stock intrinsic value show the future risk and return performance of a security. How to determine the value of a stock? So there is a four ways to determine the value of a stock. I will begin with the first one, which is par value. What is par value? Par value can be defined as a stated or face value of the stock. For example, assume company XYZ issue 1 million in bonds to the public. It may do so by issuing 1,000 bonds, each with a bond 1,000 par value. So, when each bond matures, the borrower will pay back the par value of 1,000 to the lender. The next way is through book value. What is book value? It is the amount of a stockholder equity in the firm and indicate the amount of stockholder funds used to finance the firm. Below is the calculation or formula used to evaluate the value of the book value. The third way to evaluate the stock value is through market value, or also known as market capitalization. It is defined as the prevailing market price of an issue traded in stock exchange. It is also indicates how the market participants as a whole have assessed the worth of share of stock. This is the formula or calculation to find the value of market value. I will proceed to the last way, which is investment value. Investment value normally used to determine the expectation of the return and risk behavior of a stock. It is also indicate the worth of the stock, and in investment value, this is the most important base to the stockholder. I will proceed to the value of common stock approach. So there are 5 common stock approach. I will begin with the first one, which is market value approach. Market value approach normally used widely used by public listed company. It is defined as the market value per share is the price for which the share can be sold on the market. The second one is book value approach. Book value approach is normally depends on the accounting data as found in the company balance sheet. The red color shows the formula to find the value of book value approach. I will proceed to the next approach, which is asset value approach. Asset value approach can be defined as the actual market value of a company asset is being used rather than their historical cost. So this is the formula to calculate the asset value approach. The fourth approach is net tangible approach. Net tangible asset is indicate the value of asset banking the share of a company. So this is the formula to get the value of net tangible asset. The last one of the approach is price earning ratio approach, which we use this kind of formula to get the answer of price earning ratio. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Dini Kurniati. I am student University Kuala Lumpur Business School. I want to share about the dividend valuation model and about the zero growth valuation model. I want to explain about the dividend valuation model. Dividend valuation model (DVM) is where the value of a share is a function of all future dividends it is expected to provide over an infinite time horizon. The dividend valuation model also is a useful model when valuing a company that pays a dividend and for which the dividend pattern is sustainable. The basic premise behind the dividend valuation model is that the value of a stock today is the present value of all future dividends. This model can be applied whether or not the company currently pays a dividend. But if the company does not currently pay a dividend, the analysis should be able to estimate the future dividend in amount and timing. And the last one, the dividend valuation model can be modified for patterns including a constant dividend, a constant growing dividend, and a dividend that grows at different rates depending on the period in the future. So the dividend valuation model can be related to fundamental factors that drive the value of a company's equity, including the return on equity and the dividend payout. Next, this is the version of the dividend valuation model. The first one is the zero growth model, which assumes that dividend will not grow over time. The second, the constant growth model, assumes that dividend will grow by a fixed or constant rate over time. And the last one is the variable growth model, which assumes that the rate of growth in dividend varies over time. Next, this is the zero growth valuation model. To value common stock, you must make assumptions about the future dividend growth. This simple approach to dividend valuation, the growth model assumes a constant and growing dividend stream since a preferred stock. Therefore, the 1 is the 2 is the end. Plugging constant value D into the common stock valuation formula reduces the simple equation for the present value of a perpetuity of the 1 ringgit discounted at a rate Ks. Therefore, it is also equal to value of a share of stock with annual dividend divided by required rate of a return, or PO is the O divided by K. This is a question. A local company pays a dividend of 4 ringgit per annum and is expected to experience no growth in the indefinite future. If the investor required rate of return is 10% per annum and the stock is being sold for 30 ringgit in the marketplace, should the investor purchase the stock? So we will to calculate the investor intrinsic value of the stock will be given by value of a share of stock is DO divided by K. DO is 4 ringgit and K is the rate of return is 10%. So 4 ringgit divided by 0.10. The value of a share of stock is 40 ringgit. For the question, market price, should the investor purchase the stock? Therefore, the answer is yes. This is a stock intrinsic value, which is the value the investor pays on the stock given his information and expectations of the cash flow and the riskiness of the cash flow. The answer is this answer is yes, because the investor will purchase the stock so long as PO is value of a share of stock, or the intrinsic value exceed the market value. MP is market value. So the market price reflects the marginal average investor information or expectation, which may be different from that of the individual investors, and therefore the reason for the difference in value. Okay, thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Gina Adil Yuda from University Kuala Lumpur Business School. I will share about valuation dividend constant growth. The constant growth, a model determining intrinsic value of stock based on future series of dividend, grow at a constant rate. The constant growth model is dividend growth at a constant rate less than the required return. The model is simplistic as assumption that constant rate forever is unrealistic. Next, formula for constant growth. The formula is VEO equals DO times 1 plus G divided by K minus G equals D1 divided by K minus G. Constant growth is price of stock should be equals next year dividend divided by difference rate of return and expected constant rate of growth. Next, question number 1. ABC company intends to pay dividend RM 1.75 per share and you extend to grow 4% per year and rate of return is 9%. Currently, ABC company stock is trading at RM 15 per share. So we can calculate value of stock. This is the formula VO equals D1 divided by K minus G. We can get RM 1.75 for paid a dividend and divided by 0.09 minus 0.04, we get RM 35. This is value of a share of stock. According to the model, ABC company stock is worth Rm35 but is trading at 15 Rm per share. So the stock is undervalued. Question number 2. ABC company intends to pay off Rm2 per share and you expect to grow 5% every year. Beta is 1.5, return on the market is 12%, risk-free return is 8%. Before we calculate value of stock, we must calculate CAPM. Formula of CAPM is ER or expected return equal risk-free return plus beta times return on the market minus risk-free return. So 0.08 plus 1.5 times 0.12 minus 0.08 equals 0.08 plus 1.5 times 0.04 equals 0.08 plus 0.06. So we get 0.14. This is required of return or expected return. Continue to question number 2 for calculate valuation of stock. ABC company intends to pay off Rm2 per share and you expect it to grow 5% every year. Cost of equity or required return is 14%. You get from CAPM in the previous slide. The formula of value of stock is VO equals DO times 1 plus G divided by K minus G. So, calculate is Rm2 times 1 plus 0.05 divided by 0.14 minus 0.05 equals Rm2 times 1.05 divided by 0.09. We get Rm 23.33. This is the value of a share of stock. Thank you.
Assalamualaikum. In this video, I am going to explain stock valuation, and under stock valuation, I will be explaining the dividend valuation model, under which there are 3 growth models. The first one is zero growth model, second one is constant growth model, and the third one is variable growth model. I will explain the variable growth model. This model allows for a variable rate of growth over time because future growth rates might shift up or down due to changing expectations. This is useful to consider a variable growth model that allows for a change in the dividend growth rates. I will explain how to calculate the variable growth model using an example. The entire process of finding out the value of stock is going to be a 4-step procedure. Let us assume that DO is Rm 6.8. Growth rate 1 is equal to 0 and it lasts for 1 year. Growth rate 2 is 5% per annum. It lasts for years 2 and 3. Growth rate 3 is equal to 12% per annum and lasts for year 4. Growth rate 4 is equal to 10% per annum and lasts from year 5 onwards. The required rate of return is 14%. The first step is calculating the value of cash dividends. It is done in this following method. The step 1 is calculating the value of cash dividends. Let's calculate the value of dividends for year 1. The initial dividend is Rm 6.8. Dividend for year 1 is equal to Rm 6.8 into 1 is equal to Rm 6.8. Because the growth rate for year 1 is 0. The growth rate for second year is Rm 6.8 into 1.05 because the growth rate is 5% per annum, which is equal to RM 7.14. The growth rate for year 3 is equal to RM 7.14 into 1.05, which is equal to 7.497. The dividend for year 4 is equal to RM 7.947 into 1.12, which is equivalent to 8.39664. The dividend for year 5 is equal to RM 8.39664 into 1.10, which is equivalent to 9.236304. The step 2 is calculating the PV, present value of the annual dividends that we have just calculated. Our dividend for year 1 was 6.8. So we will write 6.8. A dividend for year 2 is 7.14. A dividend for year 3 was 7.497. Dividend for year 4 was 8.39664. Now to calculate the present value of dividends, we will have to multiply it with the present value interest factor, 14% of the year of the dividends. So the PVIF 14 for year 1 is 0.8772. The PVIF 14% of year 2 is 0.7695. The PVIF 14% for year 3 is 0.6750. The PVI 14% for year 4 is equal to 0.5921. Now to calculate the present value of the dividends, we have to multiply the dividend into its present value interest factor, which gives us 5.96496. 5.4923423. For year 3, it is 5.060475. For year 4, it is 4.96241424. Now the total present value of dividends is equal to the sum of these, which is equivalent to 21.48207924. Now we move on to step 3, where we calculate the present value of the price of stock at the end of initial growth period. To calculate the present value of the price of stock at the end of initial growth period, we first have to calculate the price of stock at the end of initial growth period, for which we will use this formula: price of stock at the end of initial growth period is equal to dividend in the beginning of constant growth period divided by K minus G, where K is the required rate of return and G is the growth rate. Now to calculate the dividend in the fifth period, we will use the dividend in the fourth period in the table multiplied by the growth rate, which was 10%. Thus, the dividend for the fifth period is equal to 8.39664 into 1.10, which gives us RM 9.236304. Now that we have this value, we can substitute into the formula. D5 is 9.236304 divided by K, which was 14%, 0.14 minus G, which was 10%, 0.10, which gives us the price of stock as 230.9076. Now to calculate the present value of stock price, we have to multiply 230.9076 with the PVIF, 14% of year 4, which is equivalent to 230.9076 into, as we have calculated in the table above, 0.5921, which gives us a present value of stock price of 136.72039. Our last step is calculating the sum of present value of dividends during the initial growth period and the present value price of stock at the end of growth period. That is our PO. Our PO will be equivalent to sum of present value of dividends during initial growth period, which was 21.42, 4820, 7924 plus our PV of stock price at the end of growth period, which was 136.72039, which gives us a PO of 158.2024692. That's all.